Face the truth. And in trading, we really do need to face the truth because we all come into the market with different expectations, and those expectations are formed. They come from different ways, from other traders in the market that we know, from things that we might read online about what can be achieved in the market in a certain set of time. There's a lot of things that are going to subconsciously form opinions in our minds about what we should be gaining from the market. And the truth of the matter is that trading is a long-term venture. And in order for us to be successful over the long term, we have to make sure that we're not viewing it as a get-quick-rich scheme, because if we think of it that way, it actually will do the opposite for us. It's a quick way to lose money. And so at Forex Officials, we really have your best interest in mind, because regardless of what background you're coming from into the market, we really try to help you set realistic expectations in the beginning so that, one, you do well, right? You make money first off, but you not only make money, you discover ways and learn how to make money consistently month to month, right? You see a lot of things online about doubling your money within the first 30 days, or tripling your money by trading a certain news announcement that's going to be very volatile. Those types of market incentives are attractive for sure, but those are not long-term strategies for success. And if we really want to use the market as a medium of generating income month in and month out, and potentially at some point trading as a profession, then we have to respect the market. And respecting the market involves facing the truth about what the market can achieve for us in the beginning. And that starts with your deposit. And so having a healthy deposit in the market in the beginning is the best way to go. Statistics have shown that the greater the amount in your account initially, the more likely you are to deposit and to profit, is because you are trading with leverage. And we need to respect what leverage can do for us in the market, but also how it can hurt us if we don't respect it. And we show you how to do that here at Forex Officials, so just stick with us. High frequency trading is an interesting term in the market. It gets glamorized probably more than it should. It definitely has its place in the market in the institutional community. So if you look at hedge funds and professional outfits like that who have developed algorithms that perhaps are of a high frequency nature, that's what that's referring to. Oftentimes for us as individual traders, we confuse high frequency trading with over trading. And over trading is basically getting into positions that we have too much of a need to be in a position all of the time. Okay, we're trading more kind of with a rapid fire gun than a sniper method. And as traders, we want to be snipers. And typically, snipers are not overactive. And so, high frequency trading, you're going to hear that term a lot moving forward as well. It has its place in the trading community, but typically as individual traders, that's not something we often aspire to be, because it all comes back to our results. Does trading actively, getting into and out of positions many times per day, is that benefiting our results? Oftentimes you'll find that it's not, for no other reason than you're paying a lot of spreads, okay? And spreads, again, effectively it's your transaction cost of every position, and in the market it works as a floating loss. Right? So every time you get into a trade, you are always holding an initial floating loss that is equal to the spread on that currency pair or on that instrument. And if you look at it that way, it will help you avoid over trading. Okay? And we have certain tips and techniques as well that will keep you from doing that, which will benefit your account at the end of the day. So stick with us on that, and we'll make sure to set you right. I think it was Jim Rogers who had the famous trader who said, fundamentals, did well for me. It was technicals and price action analysis that got me rich. And so technical analysis has its place in the market for sure. And a big part of the foundation of understanding technical analysis is being able to read charts properly at a basic level, which we do for you. Our master apprenticeship covers that, as well as our one-on-one coaching. And when you're looking at charts and time frames, the premise behind technical analysis and the belief in it really is founded upon knowing that other traders are also looking at the same price action, the same charts that I'm looking at. And daily charts are very significant because they are a time frame that traders, institutions, hedge funds around the world are all looking at. Okay, and so the price patterns that are forming on daily charts hold more weight because they are more widely viewed than shorter term time frames like a 5-minute chart or a 1-minute chart. Okay, all time frames have their value and can be called upon in different instances, but the daily charts really show the picture that you need to be seeing first off. And and not to mention, they also help you avoid over trading. Okay, because you're not being presented with trading signals as frequently, and you're excluding a lot of short-term noise or short-term price action in the market that really isn't significant to many of the positions that you're looking to get into and out of. So sticking with daily charts will benefit your trading in a couple different ways. You're looking at price information that many other traders and institutions that drive volume in the market are also looking at, and it will help you avoid over trading. It's a commonly asked question from traders, especially in their first year of trading: where do I put my stop loss? How close to the market should I put it? Should I put it at different ranges for different instruments? These are all very good questions, and there is no one answer to those questions. It is an art, it's not a science. Getting stopped out is not a bad thing. I think that is the more important lesson to learn regarding stop losses. Nobody likes to get stopped out. It's not a good feeling when you take a loss, for sure, but you have to start with the notion and the understanding that getting stopped out is not a bad thing. It's part of a larger strategy to grow your account, to protect the principal that you have in the account. And at the end of the day, stop losses are serving a purpose, which is to protect the account and to live to fight another day, basically, as they say. And as far as placement goes and how far away the stop should be from your entry price on any given trade, also more important than the exact number of pips away from the entry price, okay, which will vary from trade to trade, is the ratio between your take profit order or your limit order and your stop price. That should always be a positive ratio. My take profit on a given position should always be a further number of pips away from the entry price than my stop loss price. If you're consistently doing that, trade in and trade out, you're stacking the deck in your favor, okay, when it comes to trading, because again, you're taking the pressure off of yourself to win a very high percentage of your trades, okay, because every profit is larger than every loss. And if you can consistently keep that trend going, you can be winning 50% of your trades overall and be very, very profitable. And isn't that a nice place to be as a trader? And so at Forex Officials, we help show you how to do that consistently. Educating yourself, like in any other profession in the trading industry and in the Forex industry, it works the same. The more time you're able to put in, the better you are able to master trading. Well, what's nice to know is that you don't have to be a master to be profitable. And so we deliver our education in a few different methods, depending upon your schedule, where you are located around the world, and how much you're capable of investing into your education, from day to day, from month to month. And so our master apprenticeship is nice for those of you who find yourselves extremely busy, working 100 hours a week, or whatever the case may be. The master apprenticeship is 20 hours of video that cover 40 lessons and that you can watch on your own time. So if you're flying from one city to another, you can be watching one of our videos on the plane. If you have 45 minutes before you go to sleep and you want to catch a couple videos, you can do it then. It's very convenient way of learning, and they're good lessons in there. You can watch them again and again and again. And so that's very, very nice for those of us who our schedules are just a bit crazy at the moment. The coaching is for those who have a bit more time and who want to get a bit deeper, work with an instructor one-on-one, which we typically hold over video, Skype, GoToWebinar, a number of methods. and really dig your heels in. We have, similar to those who are looking to learn a language and say, I'm going to take the next month to really work with a tutor on a specific language. We take the same approach with the trading, the tradable markets. If you want to take 30 or 60 days, dig your heels in, and we set a really robust schedule to work with you one-on-one. Our coaching is quite powerful, and I think some of our student testimonials who have come out of the coaching will tell you that it really, really benefits your results and sets you on the pro track much faster.